Right now, something is happening in the gold and silver markets that almost nobody is explaining correctly. Gold is falling during a war. Silver is flat, while industrial demand hits a record. The mainstream media tells you it is interest rates. The central bankers tell you inflation is under control. The analysts tell you to sell. They are all missing the story. Because the price you see on your screen, that is not the real market. That is a paper market, a derivative market, a fractional reserve market. And that market is starting to break. Let me give you a number. In March of 2020, during the COVID panic, gold futures on the COMEX traded more than $70 over physical spot prices. $70. That is not a normal market. That is a market screaming that the paper promise cannot find the metal. We are watching the same mechanism build again. Only this time, the leverage is higher, the inventory is lower, and the unthinkable is no longer whether the paper market breaks. The unthinkable is what happens after. By the end of this breakdown, you will understand three things. First, why the price of gold and silver has stopped telling you the truth about physical demand. Second, the exact five-step mechanism that creates a paper market squeeze. And third, the specific numbers you need to watch to know when the system reaches its breaking point. I have spent decades watching markets break in predictable ways. The pattern is always the same. The narrative always lags. And the opportunity always belongs to the person who understands the mechanism before the price reflects it. If you value this kind of system-level analysis, subscribe now. Because what I'm about to show you is not a prediction, it is a map. Stay with me. Let me start with the puzzle. Over the last 12 months, central banks have bought more gold than in any year since 1950. Not since the Bretton Woods era. Not since Nixon closed the gold window. Since 1950, China has reported gold purchases for 18 consecutive months. They are not stopping. Russia is buying. Turkey is buying. Poland just added another 100 tons. These are not speculators. These are the people who run the world's monetary reserves. And they are accumulating physical gold at a pace we have not seen in a generation. Now look at silver. Solar panel manufacturing is exploding. Electric vehicle production is exploding. And every single solar panel, every EV, every 5G tower requires silver. Industrial demand for silver is projected to exceed supply this year by the largest margin in more than a decade. So here is the puzzle. If central banks are hoarding gold and industrial demand is crushing silver supply, why are both prices sitting below their historical highs? Why did gold drop while Israel and Iran exchanged fire? Why is silver barely moving while the green transition consumes record tonnage? The mainstream answer is interest rates. Higher real yields make non-yielding assets less attractive. That is true. It is also incomplete, because there is another market happening underneath the one you see on television. There is the paper market, where futures contracts trade 100 ounces of gold that do not exist. And there is the physical market, where bars and coins change hands for delivery. Right now, those two markets are telling completely different stories. The paper market says gold is weak. Open interest on COMEX. Gold futures remains elevated while prices drift lower. That suggests speculators are short. That suggests hedge funds are betting on lower prices. The physical market says something else entirely. Premiums on 1-ounce gold coins in London are at levels normally reserved for panic. Retail dealers cannot keep silver bars in stock. And the inventory of gold sitting in COMEX registered warehouses, the metal that is actually available for delivery, it has dropped nearly 60% from its peak in 2020. Now here is where this gets important. The paper market is not real, it is a promise. A futures contract is not gold, it is an IOU for gold at a future date. And the entire system relies on the assumption that when that contract comes due, the metal will be there. That assumption has not been tested like this since March of 2020, and it has never been tested with central banks buying this aggressively in the background. Let me show you exactly how this mechanism works, because once you see the steps, you will understand why the unthinkable is not a conspiracy theory. Now let me walk you through exactly how this breaks. I want you to write this down, because the sequence is the same every time. The players change, the scale changes, but the mechanism is mechanical, predictable, and once you see it, you cannot unsee it. Step 1. Fractional reserve, leverage on the exchanges. Here is how the COMEX works. For every ounce of gold that sits in the registered vaults, metal that is available for delivery, there are roughly 100 ounces of paper claims trading in the futures market. 100 to 1. That is not a conspiracy. That is the design. The exchange allows it because most contracts are cash settled. Most traders roll their positions. Most never ask for the metal. But here is what that means. If just 1% of paper contracts demanded physical delivery at the same time, the system would run out of metal. Not hypothetically, mathematically. Step 2. The concentrated short structure. The bullion banks, JP Morgan, HSBC, Scotiabank, they are the largest short sellers in the gold and silver futures market. They sell paper metal they do not own. They hedge their vaults. And for decades, this has worked because physical demand was always satisfied by new mine supply or recycled scrap. But that balance is gone. Central banks are not selling. They are buying and holding. Mining supply is flat to declining, and the scrap market is exhausted after the 2020 spike. The bullion banks are now short a market that has no available metal to cover them. Step 3. The drain on registered inventory. This is the number you need to watch. COMEX registered gold inventory peaked near 40 million ounces in 2020. As I record this, that number has fallen below 20 million ounces. That is not a fluctuation. That is a structural drain. Every time someone takes delivery of a futures contract, metal leaves the registered category. And right now, the people taking delivery are not hedge funds. They are not speculators. They are central banks, sovereign wealth funds, large physical holders who will never sell that metal back into the paper market. Once metal goes into their vaults, it is gone. Permanently. Step 4. The rolling crisis, backwardation and lease rates. When physical becomes scarce, the futures market stops behaving normally. Normally, future prices are higher than spot prices. That is contango. It reflects storage and financing costs. When physical is tight, future prices fall below spot. That is backwardation. And backwardation in gold is rare. It happened in 2020. It is starting to appear again. Simultaneously, gold lease rates, what it costs to borrow physical gold, have spiked. When lease rates go high, it means no one wants to lend their metal. And when no one wants to lend, the short sellers cannot borrow to cover. The mechanism begins to seize. Step 5. The breaking point. Price stops being the signal. Here is what most people misunderstand. When a physical squeeze reaches its final stage, price discovery does not go up cleanly. Price discovery breaks. The paper price may trade at $2,000, while physical buyers are paying $2,200. The futures market may show a bid, while dealers refuse to quote. The exchanges may raise margin requirements, limit positions, or halt trading entirely. That is not a crash. That is a market admitting it cannot perform its function. And that is the unthinkable. Not a gold price of $3,000 or $5,000. The unthinkable is a two-tiered market. Paper gold for speculators. Physical gold for those who understood the mechanism before the break. Now let me show you why almost everyone is reading this wrong. I want to debunk 3 myths, because the mainstream narrative is not just wrong. It is dangerous if you are holding paper exposure without understanding the underlying mechanism. Myth 1. Gold is falling because real interest rates are high. This is the most common argument, and on the surface, it makes sense. Higher real yields increase the opportunity cost of holding gold. Therefore, gold falls. But here is what that argument misses. Real interest rates are calculated using inflation expectations. And inflation expectations are manipulated by the very central banks buying gold. The Bank of Japan holds negative real rates. The People's Bank of China holds artificially suppressed rates. The European Central Bank is trapped. And the Federal Reserve? Real rates are positive only if you believe their inflation numbers. If you measure inflation the way they did in 1980, real rates are still deeply negative. So here is the truth. Gold is not falling because real rates are high. Gold is consolidating because the paper market is levered and the physical buyers are waiting for the price to break lower so they can accumulate more. That is not weakness. That is patience. Myth 2. Silver is just an industrial metal now. It no longer trades like money. This is true but incomplete. Yes, silver has industrial uses. Yes, those uses are growing. But that does not mean silver has lost its monetary properties. It means silver has two sources of demand instead of one. And right now, both sources are rising. Industrial demand is at a record. Investment demand is rising because retail buyers cannot afford gold at $2,000 per ounce. Silver at $25 is the everyman's hedge. That dual demand creates a squeeze dynamic that pure industrial metals like copper do not have. When industrial demand rises and investment demand rises and mine supply is fixed, something has to break. That something is the paper market. Myth 3. The COMEX has always settled. It will settle this time. This is the most dangerous myth of all. The COMEX has always settled because the bullion banks have always been able to source metal from somewhere. In 2008, they sourced from ETFs. In 2020, they sourced from central bank deposits and retail bars. But those sources are depleted. The ETFs have seen outflows for 2 years. Central banks are not lending their metal. And the retail market is holding tight after the 2020 premium spike taught everyone that physical is different from paper. So where does the metal come from this time? The answer is uncomfortable. It comes from price. The paper market will have to rise high enough to force physical holders to sell. But if those physical holders are central banks diversifying away from dollars, they will not sell. They are not price-sensitive buyers. They are structural buyers. That means the paper market could rise to $3,000, $4,000, $5,000 per ounce, and the physical metal still will not come out of central bank vaults. That is not a short squeeze. That is a regime change. Let me zoom out now, because what we are watching is not an anomaly. It is a pattern, and this pattern has happened before, twice in the last 50 years, and both times the mainstream media got it wrong until the day it became obvious. Now zoom out with me. In 40 years of watching markets, I have learned one thing that matters more than any indicator. Patterns repeat. The details change. The underlying mechanism does not. What we are watching in gold and silver right now has happened twice in my lifetime. And both times, the mainstream narrative was exactly where it is today. Confused, dismissive, focused on the wrong variable. Let me walk you through the two most important historical comparisons. 1979 to 1980. The world was exiting a decade of inflation. The dollar was under pressure. Geopolitical risk was high. And the paper gold market on the COMEX was massively leveraged relative to physical supply. What happened? Gold went from $200 to $850 in 12 months. Silver went from $6 to $50. The Hunt brothers tried to corner the silver market, yes, but they succeeded only because the underlying physical structure was already tight. The paper market was stretched. And when physical demand overwhelmed it, price discovery did not work smoothly. It exploded. The mainstream media called it a bubble, and on the price chart, it looked like one. But the mechanism was not speculation. The mechanism was a paper market that had promised more metal than existed, and physical buyers who refused to sell at any reasonable price. That is not a bubble. That is a settlement crisis. 2008 to 2011. After the financial crisis, central banks printed trillions. Real rates went negative, and physical demand for gold and silver surged. But here is what most people forgot. In late 2008, the GLD ETF traded at a 40% premium to spot gold. 40%. Why? Because the ETF could not create new shares fast enough to meet physical demand. The mechanism seized, and that premium was the market screaming that paper claims and physical metal were no longer the same thing. That premium lasted for months. And when it finally normalized, gold had begun a rally from $700 to $1,900. Now here is the structural lesson from both of those periods. The trigger is always the same. Physical demand rises. Paper leverage stays high. Inventory falls. And then some event, a bank failure, a geopolitical shock, a margin call, causes a small number of paper holders to demand delivery. That small number is enough to expose the fractional reserve nature of the system. Once that exposure happens, the market does not correct gradually. It reprices violently. Because the price of gold is not set by supply and demand in any normal sense. It is set by the credibility of the paper system. And credibility, once lost, is not regained at the same price level. Now here is what makes today different from 1980 and 2008. In 1980, the Federal Reserve could raise rates to 20% and break the back of inflation. In 2008, they could bail out the banks and backstop the system. Today, the debt is 3 times larger relative to GDP. The central banks are trapped, and the buyers of physical gold are not hedge funds or retail speculators. They are the central banks themselves. That changes everything. Because the people who normally provide metal to the paper market are now the people taking it away. You cannot bail out a market when the lender of last resort is on the other side of the trade. This brings me to the final piece. What you need to watch. Because the price today is not the signal. The plumbing is the signal. Let me give you 4 specific indicators. Watch these numbers, not the headlines, not the analyst price targets. These data points will tell you everything the mainstream media will miss until the day the system breaks. Number 1, COMEX registered gold inventory. As I said earlier, this number peaked near 40 million ounces in 2020. It is now below 20 million. But the threshold you need to watch is 12 million ounces. Why 12 million? Because that is approximately the amount of gold that trades in a single week of high-volume futures delivery. When registered inventory falls below 2 weeks of potential delivery demand, the exchange enters what Treas which Korobat Sang's technical default risk. Watch for the weekly inventory reports every Thursday. When you see the number cross below 12 million, the probability of a delivery crisis moves from theoretical to imminent. Silver lease rates. The London Bullion Market Association publishes lease rates for gold and silver. Normally these rates are low, 1% or less. When they rise above 2%, it means physical holders are demanding a premium to lend. When they go negative, that means lenders are paying borrowers to take metal. That sounds counterintuitive. But negative lease rates indicate that no one wants to lend because they fear they will not get the metal back. Negative lease rates in silver happened briefly in 2020. If they happen again and persist for more than a week, the physical squeeze is real. Number 3, the gold forward rate, or GOFO. This is the most technical indicator, but also the most reliable. GOFO measures the cost of swapping gold for dollars in the forward market. When GOFO goes negative, it means the market is paying to borrow gold. That is backwardation. And backwardation in gold is the single clearest signal that physical is scarce. GOFO went negative in late 2008. It went negative again in March 2020. Both times, gold prices rose sharply in the following months. Watch the 1-month and 3-month GOFO rates. If they go negative and stay negative for 2 consecutive weeks, the mechanism is locked in. Number 4, retail physical premiums. This is the signal you can see without a Bloomberg terminal. Call a dealer, check online. What is the premium on a 1-ounce gold American Eagle? What is the premium on a 100-ounce silver bar? In a normal market, those premiums are 3 to 5%. In March 2020, they spiked to 30% on silver and 15% on gold. Today, as I record this, premiums are elevated but not extreme. That is the calm before. When you see premiums double from current levels, it means retail buyers are panicking. And retail panic in physical metals is a self-fulfilling prophecy. It drains inventory. It tightens lease markets. It accelerates the mechanism. Watch those 4 numbers. They will tell you the truth long before CNBC does. Let me close with something important. I am not telling you that the paper gold market will collapse tomorrow. I am not telling you to sell your house and buy silver bars. That is not how I think. That is not how any serious macro observer thinks. What I am telling you is that the mechanism is in motion. The inventory drain is real. The central bank buying is real. The paper leverage is real. And the historical pattern is clear. When physical demand rises, paper leverage stays high, and inventory falls, the system eventually breaks. Not because of conspiracy, not because of manipulation, because of math. The unthinkable is not a gold price of $5,000. The unthinkable is a market where paper gold and physical gold are no longer the same asset, where futures contracts trade at one price and bars trade at another, where the exchange steps in and changes the rules mid-game. That is not a prediction. That is a map. You can ignore the map. Most people will. They will watch the price, read the headlines, and assume the system works until the day it does not. That is human nature. But you now know what to watch. You know the numbers. You know the mechanism. The question is not whether the paper market can break. The question is what you will have done before the headlines tell you it already has. In 40 years of watching markets, I have learned this. The pattern always repeats. And the people who understand the mechanism before the price moves are the ones who sleep well when everyone else is panicking. Watch the inventory, watch the lease rates, watch the premiums, and remember, the price on your screen is not the market. It is just the paper promise. The metal tells the real story.